Most Americans, as their income begins to climb, they pay more and more in taxes, all the way up to the highest tax bracket of 37%. But most billionaires pay virtually nothing in taxes. And they discovered that if you don't make income, you don't pay income taxes. So if you buy an asset that goes up in value, that growth is not taxed. If you borrow against that asset, those loan proceeds are not taxed. And if you die and you pass on those assets that are growing in value to your heirs, that is not taxed. But if you earn a wage, that is taxed. And if you sell that asset, that is also taxed. I'm Terrell Higgins, a real estate and personal finance nerd, and today I'm going to be breaking down the buy, borrow, die strategy that allows billionaires to pay $0 in tax. I'm going to show you exactly how you can implement it in your own life and pay no taxes. Let's get into it. So the first step of this process is to buy appreciating assets. So assets that are going to go up in value over time. As most of you realize, your assets minus your liabilities is your net worth. So if you can buy assets that are going to grow over time, then your wealth is also going to grow over time. So the type of assets you should be looking at would be stocks, real estate, businesses, or whole life insurance policies that have a cash value associated with them. So if you buy these assets, they're going to grow over time, and that growth is not taxed. The top 1% of households in the United States have $21 trillion of unrealized gains on their assets. And this is the reason why. Because those gains are not taxed unless they sell the asset. So if you hold onto the asset and you never sell, you never get taxed. Everyone has different assets that attract them more than others, but the key is whatever asset that you select, you have to be willing to hold for the long term. You have to be willing to pass it down from generation to generation, because you cannot sell if you want to execute this strategy. So we're at step 2, borrowing against those assets. So if you need cash from your assets, you really only have 2 options. You can sell the asset and you'll have to pay capital gains taxes on that asset, or you can borrow against that asset. And there are several benefits to doing it this way. So the first benefit is that loan proceeds are not considered income, so they are not taxed. The next benefit is when you borrow against that asset, instead of selling, you don't break the compounding cycle on that asset. It stays invested and it can keep compounding and growing. And the most powerful thing is borrowing against an asset to buy another asset. So imagine you have $100,000 in stock, and then you borrowed $50,000 against that stock, and you purchased $50,000 more of stock. So you turned your $100,000 of stock into $150,000 of stock. You can apply this same principle into businesses, where you can take out a business line of credit or a secured loan on your business and buy more businesses. Or you can do this with real estate, where you can do a cash out refi, take that money and buy more real estate. There's actually an entire investing strategy designed around buying a property, increasing the value through rehabbing it, doing a cash out refi, and rolling that money to the next property and the next property. It's called the BRRRR strategy. And a lot of people who have hundreds and hundreds of doors of real estate, that is the strategy that they employ to grow their portfolio. If you're curious how you can access the equity in your home, I actually did a video on how you can access the equity in your home. And one powerful thing about using the proceeds from your asset to buy another asset is that that loan interest becomes tax deductible. So if you're using it for personal reasons, that loan interest is not tax deductible. But when you use that loan from your asset on another asset, that interest becomes tax deductible. So you can use that loan interest to offset some of your other income. Warren Buffett is a master of these tax strategies, and he pays an effective tax rate of about 0.1%. His assets are growing in a way that is not taxed, and any actual income he has, he's able to offset with this interest and deductions. So he pays virtually no taxes.
I don't think our tax system is very equitable, and I think it drifted dramatically in the last 10 years toward favoring rich guys like me. So I pay a lower tax rate on much of my income than my cleaning lady does. And I think that's crazy.
So what are the risks here with borrowing against your assets? You have to keep up with those payments. If you stop paying, then it puts your collateral at risk. You could lose that underlying asset. And then the other thing is you have to stay on top of the tax laws, because they're constantly changing, they're constantly moving, and you have to make sure that you stay in compliance. And then the last thing is, if you're employing this strategy, it puts you at risk of being audited by the IRS. They don't like it when people pay $0 in taxes. So you will need sound representation for you to make sure all your documentation is right. And when they audit, they don't find anything except compliance with the current laws. And the final thing to think about is that you're actually running against public sentiment. People don't like to hear you're making a ton of money and paying zero taxes, so it might impact your reputation. But if you're okay with all these risks, then this strategy might be for you. So how do you actually borrow against your assets? So if it's stock, you can do a securities-backed line of credit, or you can do a portfolio loan. And if you're using your stock to buy more stock, you can actually do a margin loan. And if it's a business, you can do a business line of credit or a secured loan to buy more businesses. And if you're doing real estate, you could do a home equity loan, a cash out refinance, or use a HELOC to buy more assets. And then the last thing to consider is if you have a whole life insurance policy that has a cash value, you can actually borrow against that whole life insurance policy. And then the premiums that you are paying will go to repaying that loan that you took out on that policy. But this only works with whole life insurance. It's not something that you can do with term life insurance policies. So this brings us to the last component to this strategy, dying. So when you die and your heirs inherit all your assets, they inherit them at fair market value. And when they inherit them at fair market value, it essentially wipes out all the capital gains on those assets. Let's do a little example here. So say you had a property that you purchased for $100,000 and then it appreciated to $500,000. And then you decided to sell that asset. You would have to realize a $400,000 capital gain, and that would be taxed. But if you have an asset that you aren't going to sell, because we just established that you cannot sell your assets at any point, and you hold it and it's $500,000, and then you pass it down to your heirs, and then once they inherit it, they decide to sell it at $500,000, they're going to pay zero capital gains. And that is because they compare it to fair market value. And this concept is called a step up in basis. So the basis that you bought the property at, that $100,000, does not get transferred to your heirs. They have a new basis, which is the fair market value at the time of your death. that $500,000. So this effectively wipes out all the capital gains and you pay no taxes.
More money, more money, more money.
So you might be thinking, what about the estate tax? And the truth of the matter is the estate tax doesn't apply to most people. The estate tax is only on estates that are greater than $13 million if you're single, or $27 million if you're married. And if you are above those numbers, you can still get around the estate tax with the use of irrevocable trust, but you definitely want to seek out a professional to set these up to make sure everything is above board. So that's the buy, borrow, die strategy. Let me know in the comments below if you would ever actually consider utilizing this strategy. I personally don't like the scrutiny of the IRS of me paying zero taxes, so I'd rather just pay my fair share of taxes. But if you're interested in this strategy, please let me know in the comments below. And if you're curious what other assets the ultra wealthy are using to grow their wealth, I actually did a full video on the investments that are only available to accredited investors. So you'll get to see all the exotic investment types that the ultra wealthy are using to grow their wealth. Thanks for tuning in, and I'll catch you guys next time.